the market today. Joining us, Jason Trennert, chairman at Strategas Research Partners, David Zervos, Jefferies chief market strategist, and still with us, Karen Finerman, Metropolitan Capital President. Let's go to you first, David Zervos. Takeaways from the Federal Reserve and the news conference.
Well, I think it was actually a pretty dovish and kind of almost a somber message, and I think that's why the equity market got a little bit soft as it really read into Jay's remarks. They weren't that upbeat. It was a downgrade of the consumer, and I think a reasonably meaningful one. And I think the change on the inflation language was also sort of a negative, really, in the sense for the market, in that they're still not able to really see themselves getting to that 2% number, and they feel like they need even more accommodation to get there. So this was not a Fed message that I thought was really, really exciting for risk assets.
Isn't that exciting when the Fed is downbeat on the economy and on inflation, and because the translation is more accommodation?
It is if you're long a lot of fixed income, and the fixed income markets did pretty well. But again, the two-year note's running out of a little room. So what we saw is continued flattening, and we're back to some of the flattest levels we've had in a while. In fact, this year the curve's flattened, depending on whether you look at swaps or cash, almost 20 basis points between 2s and 10s. That's not a signal that's going to go great for the stock market. It's going to be something that says, hey, maybe there's a red flag. So I think I actually do think it was a more somber message. Yes, Sarah, there will be more accommodation coming, but doesn't it sort of take kind of a little messiness to get us there first? Yes. So that may be the reason the stock market's a little bit soggier than you otherwise would have expected with a very accommodative Fed message.
Is this the part where you say don't read into the gut reaction to the Federal Reserve?
Well, the initial reaction was a little bit of upside move, and then we sort of lost it. But I agree, it really was just staring at the yields coming in the way they did. And just to, I agree with David in the sense that it was a dovish message, but it was also one of kind of resignation. It's like, we don't really know what we're doing here on inflation. We're going to wait until it gets up and past 2%, but it doesn't seem like we're heading there. So it was a kind of a low and slow type takeaway. Don't want to build in too much meaning to an hour and a half's worth of market action, because yesterday's bounce in the market was a little bit mechanical and just got us up into this neutral zone. So we might just be still in chopping pullback range in a shallow way at least.
You agree with the somber assessment? He said coronavirus is serious, still said looking for signs manufacturing's recovering.
I think the somberness really comes from the fact that the 10-year Treasury yield is lower and the curve is flattening. Now, part of that could be for things that are pretty transitory, whether it's coronavirus. But I think, the Fed was probably looking forward to having a year where it didn't have to do much after it eased 3 times last year. And now you're in a situation where the curve is flattening again. It may be forced. And the Fed makes a distinction between a flattish curve and an inverted curve. By the same token, they want the curve to be steeper. They want 10-year Treasury yields to be stronger. And of course, now that you have trade behind you, I think everyone was looking forward to a stronger global growth profile for this year. I know I am, but it may take longer to get there, and that may be part of the reason, maybe what David is picking up, same thing I'm picking up, which is you want it to be the real thing.